Hello, everyone, and welcome to our monthly webinar. My name is Justin Cooper, and I am a hard money lender and full-time real estate investor. Each month, we bring in some of our friends in the industry to share their expertise. This may be through a presentation, like when we talk about self-directed IRAs or title insurance, or we may simply interview our expert friends and dive deep into how they got started, where their investing has taken them, and what they see coming both for themselves and for the industry. Now, I want to say thank you to everyone who made it to tonight's event. We know that you're giving up some of your special time, so Stephanie and I will do everything we can to bring you the value that you're hoping for. This webinar is brought to you by Pine Financial Group. Pine Financial is Colorado and Minnesota's premier hard money lender. Pine focuses on the needs of Colorado and Minnesota real estate investors, and we are investors ourselves, so we know what it takes to get deals closed. Everyone at Pine Financial Group is dedicated to the success of its clients. We only experience success when our clients are succeeding. So we have a habit of telling you when a deal should or should not be done. And isn't that what you want from a professional in the industry, especially someone that you trust as an advisor? You will benefit from our honesty and integrity when you choose to work with us. Now, tonight's webinar brings in a longtime friend and attorney, Stephanie Long. Stephanie is a frequent seminar speaker and instructor with a published author. She is a principal of Long Law Group, LLC, a law firm located in Denver, Colorado. Her firm specializes in assisting business owners and real estate investors with their tax and business needs. Stephanie, I gave him just a quick overview. Can you go ahead and tell us a little bit more about yourself before we dive into tonight's presentation?
Yeah, sure, Justin. Thank you. Thank you first for having me. I think this will be a good presentation for everybody to give you an idea about tax reform and the changes that are coming up here for 2018 and on. I am a tax attorney. I have my own law firm, which is located in Denver in the Cherry Creek neighborhood. And I've been in business I'm going into my 16th year of practice. Our firm specializes in assisting real estate investors and small business owners. We handle tax planning, tax preparation, business entity formation. We do bookkeeping, estate planning. So really kind of almost a one-stop shop for your business and tax needs. Again, I think what a lot of people on the call tonight will recognize our firm name for, and that's, again, for assisting real estate investors. So that's what we specialize in there.
Perfect. Yeah, we obviously have you to several of our events, the Pine Financial events, whether it be the Investor Success Summit or our happy hours or just classes that we do together. So you guys have been an amazing resource because we know that you're out there on a national level, but you're also here locally supporting all the folks in our local markets as well.
Yeah, we definitely have, many of you on the call we've probably met with or talked to already, and our goal is obviously to assist real estate investors and business owners with the challenges they face on a daily basis with their taxes and their running their business. So we're really here to help support that.
Yeah, very good. Well, Stephanie, if you don't mind, let's dive in. We're at a really interesting time here, the beginning of 2018, and a pretty big tax reform has just gone on. So can you dive in and run with the presentation you put together, kind of outlining some of the things that might affect us as real estate investors?
Yeah, just one or two changes. I mean, just kidding. There's been obviously so many changes. It's unbelievable. I mean, as I mentioned, I've been in practice for going into my 16th year here, and I've never seen anything like this. So lots of things that we'll talk about tonight. Obviously, I can't, within the hour that we have or so, I'm not going to cover everything, but I've tried to include in the presentation the things that I think will apply to most of you. We are going to leave a few minutes at the end for questions and a Q&A session, so you can go ahead and wait until the end to ask some questions, and then certainly if something doesn't get answered during the presentation tonight or at the Q&A, feel free to give me a call or shoot me an email. I'll put my contact information up at the end of the presentation, and I believe we're listed on Pine Financial's website as well. So we'll just jump right in here.
Yeah, so quick note there, Stephanie. So the questions, as people are on the webinar, there should be a little questions box jump in. That's what we'll be using to ask and answer any questions as we go. And also, we're gonna, if fingers crossed things go well, record this and put it up on Pine Financial's YouTube page. So if it is something that you want to refer back to, or just listen again, because I think there's going to be a lot of great info in here. We'll be putting out the link to our YouTube page hopefully in the next day or three.
Yeah, I definitely will check the chat box as well, and I'll try to answer the questions as we go along here, and then, at the end, if you have more questions, you can certainly ask those as well. So I think we've already kind of covered what I do, so we can kind of maybe skip over these slides here. Oops. There we go. Okay, and we already discussed what our firm does, so we can skip over right there. Okay, so this is just kind of an overview of what we'll be talking about this evening, and we're going to go through, starting at the top here, the tax rate changes. So the taxable income brackets have changed. They've actually decreased a little bit, so that's a good thing. We'll go through the standard deductions and exemptions. I'm going to spend probably most of the presentation on the Section 199A deduction. Some of you who've been following tax reform, you've probably heard about that, and that is that 20% deduction that will apply to what we call pass-through business income. So that's going to actually be important for a lot of you. So we'll spend, like I said, the bulk of the presentation probably going through that, since it's for sure the most complicated of all the changes. We'll talk about meals and entertainment, mortgage interest changes, the property state tax deduction, and the cap that we have there now with the $10,000 limitation, miscellaneous itemized deductions, 1031 exchanges, casualty theft losses, and then we'll go through some of the miscellaneous changes that we've seen there as well. Okay, so I wanted to put up a slide here just to show you how the tax brackets are changing, and the top taxable bracket is, it currently goes up to 39.6%. So you can see that we have a decrease there. I mean, it's certainly not huge, but hey, we'll take it, right? For most of you, you're probably going to see a little bit of a reduction there as to where your tax bracket is going to apply. But of course, as I'm going to say throughout the entire presentation tonight, a lot of what we're going to talk about tonight, unfortunately, I'm trying to give you the information that applies to your situation, but a lot of this is really going to be based on your individual facts and circumstances. So, something that applies to one person, could be completely different for another person. And because a lot of these things are based on things like what's your taxable income. And so we'll see throughout the presentation tonight that if your taxable income reaches a certain level, well, then we start to see restrictions and things for taking some of these deductions. And then if your taxable income falls below a certain level, well, then you now can take the deduction. And then, of course, as you can see on this chart, I mean, where these tax brackets are going to fall, it's really going to depend on where your income is. So, a takeaway for tonight, if you don't take away anything else, is I think you really need to speak to your tax professional, especially if you have any significant questions, and especially when we get into that Section 199A deduction, because some of these things are going to require planning so that you could take advantage of some of these tax deductions. And then you also want to know how some of these changes are going to affect you. I mean, as we'll talk about in a little bit, I mean, if you've got a W-2 job and you're in the habit of taking a tax deduction for your unreimbursed employee expenses, if you're in sales, for example, and you're currently doing an itemized deduction for those expenses, you're going to see that those are now eliminated under the new tax reform. So again, you really want to be working with your tax professional to see if how it's going to apply to you, your individual facts and circumstances, and also is there anything you can do to maximize some of these deductions or make up for it because you're going to lose certain things. So again, just kind of keep that in mind as we're discussing here. Okay, so currently the standard deduction, for 2017 and before, it was about half of what we're seeing here. So they have actually doubled the standard deduction that you can take, which is going to actually affect certain people who maybe were on the borderline of being able to take their itemized deductions or take the standard deduction, or for people who, just didn't have enough deductions to itemize their deductions. They now are going to see quite an increase there on their standard deductions. So, just to kind of give you a brief overview, the government just gives you this deduction, and all it does is it's just an automatic amount that you get for married taxpayers, or if you're single or head of household, and you just automatically get it. It just automatically reduces the income, and then that, in effect, lowers your tax because you're not paying tax on as much income. So, again, previously on the standard deduction, it was about half of what you're seeing here on the slide. They've doubled that. It's going to eliminate the need for many of you to itemize your deductions now. So for a married couple, if you have itemized deductions, meaning, you're deducting your mortgage interest and your property taxes and maybe some medical and your charity, if all of that for the year totaled $20,000, well, and you previously itemized and prepared a Schedule A, well, now you don't need to even prepare that Schedule A anymore. You don't need to itemize. You can just go ahead and take the $24,000 automatic deduction. So if you, if you exceed the $24,000 number, which, many of my clients certainly exceed that based on their mortgage interest deduction and their charity and some other things, then you will go ahead and you'll continue to itemize and file a Schedule A. So just a note here that they are making that more desirable. But you can see here, and then it is going to be, every year we are going to see an increase for inflation just a little bit, so those numbers will go up each year. You can see, though, that the exemptions have gone away, so those are actually eliminated. So what that means is, if you had a household of four, you typically would get a $3,000 or $4,000 exemption deduction, which again just reduced the income and in effect reduced the tax that you had to pay. Well, now you no longer get the exemption. So depending on your household size, if you have several children, you could be losing a big deduction there. So, whether or not this increase in the standard deduction is going to make a difference, again, it's really going to depend on your facts and circumstances. So for some of you, this is going to be great, especially if you didn't itemize before because you didn't have enough, and if you don't have a household, full of children. But for others of you, you could actually come out to be, in worse shape than you were going into this. So just keep that in mind. But again, you'll need to speak to your tax professional about that. Okay, so we will talk next about the Section 199A deduction, because this is going to be very important for most of you on the call, because if you are in the business of buying and selling real estate, if you have rental properties, this pass-through tax deduction is going to actually significantly benefit you, most of you anyway. So we'll talk about this, like I said, and this is actually the most complicated of all of the changes, in my opinion. And so you are going to definitely have questions. Again, I encourage all of you, if you have more questions after this, which you for sure will, because you're going to have to look at your individual circumstance, and you'll see that there's some complications that we'll talk about. But again, give us a call if you want to go through this. Give your tax professional a call. Hopefully they have stayed up to speed on this change, because it does tend to get a bit complex. So what is it? Why do we care? The change applies to pass-through businesses. So generally, a pass-through company is really any company that passes through the business income to the owners. So that would be S corporations, LLCs, taxes, partnerships, single-member LLCs, and it actually also applies to sole proprietors. I don't know why they call it the pass-through deduction when it applies to sole proprietorships, and a sole proprietorship is really just somebody who has not officially set up any kind of LLC or corporation. They're really just doing business through their personal name, and they file a Schedule C on their personal taxes and don't file a separate tax return. But any of those businesses, they will be entitled to take this up to this 20% deduction on their qualified business income. And obviously that can be very valuable. Just to give you a brief example, if you have let's just say you have an LLC that's taxed as a partnership, and your portion of the income is $100,000 per year, you can potentially take a $20,000 tax deduction there, which means you're only paying tax on that $80,000. If your tax bracket, if your effective tax bracket is 40%, that's saving you $8,000 per year. Again, real rough example there, but that just gives you an idea of how this works. So, and we're going to talk about what a qualified trade or business is, and we will also talk about some of the restrictions based on where your income is at. So currently, if you have a qualified trade or business, and if you're married and your taxable income falls below $315,000, and if you are single or married filing separately and your taxable income falls below $157,500, you automatically qualify for this 20% deduction. You don't need to jump through any hoops to obtain the deduction from there. But we'll see, as with anything that they do within the tax code, anytime you start making a little bit more money or where they think that you're making, that beyond what an average taxpayer makes, you're going to start to see restrictions on being able to obtain this deduction. And then even worse, which we will talk about towards the end here when we're going through this section of the presentation, if you are in a service business, it's even worse. You'll see that there's even more restrictions. So we'll talk about all of that, but just note that, again, if you want to look back and look at your taxable income, if you just want to do a quick check here, you could go back to your 2016 tax return, check page 2 of your 1040, see what your taxable income is, see if you're falling, well within these limitations. And then if you are running a trade or business, you'll note that you probably are going to qualify pretty easily to take that 20% reduction on the qualified trade or business income. If you know that your income is going way beyond that, you want to give your tax professional a call here pretty quickly so that you can make sure you understand what, if anything, you need to do to be able to maximize this tax deduction.
So question for Stephanie on that slide. What if you have multiple businesses? Does each business then potentially qualify for that 20%?
Each business will qualify. Just keep in mind, though, that if you have, let's say you have 4 businesses and 3 of them have a profit and 1 has a loss, you have to net out the income. So the one that has a loss is actually going to reduce the overall amount that you can take the 20% on. But yes, if you have several businesses, each one will qualify. Potentially, though, so keep in mind that you still have to look at each business individually, meaning you have to have the qualified trade or business income, and then remember, we're talking about if you're a service professional, you might have some limitations on that specific business income. So each business is going to have to be looked at individually, if that makes sense.
Gotcha. Yeah, I think that helps. It was a question from from one of the listeners, so I hope that gives a little bit more info.
Yeah. So, just to kind of put it a little bit clearer, so let's say that you have one business that has rental properties and that one brings in $10,000 per year. And then let's say you have business 2 and that one has a $20,000 loss. Unfortunately, you're not going to be able to take the reduction on the $10,000 of income. You're going to overall for the year have a loss. And the loss actually gets carried over to the next tax year. And you potentially have to reduce your income even more going into the next tax year so that the next tax year, if you have all a profit, you still may have some losses carrying over from the prior year, which reduces the income where we calculate the 20%. So again, I just want to mention here, this is complicated. I mean, this was even complicated for me to learn all of this. I had to spend, a long time going through the different regulations, the tax code as far as what they had drafted. There's actually a few technical mistakes that they made within this, within the tax reform bill because they did it so quickly. So, we're still waiting for them to clear up some confusion we all have. I certainly don't expect everybody on the call to know the technicalities here, but I just want you guys to have kind of a good idea about how some of this works. Okay. All right, so mentioned before that this affects pass-through businesses. So I think most of you are going to be running one of the types of businesses going through numbers 1 through 4. C corporations, which some of you certainly may have. So a C corporation is is a type of business entity that is not what we call a pass-through. So if the C corporation has a profit, the profit stays in the corporation pays the tax. And if there's losses, the losses also stay in the C corporation. So if you're running a C corporation, just note that you will not be entitled to take this 20% reduction on the pass-through qualified business income. There is a lower tax rate that now applies to C corporations. There's just a flat rate now of 21%. So you may still be happy to note that the corporate tax rate has been reduced. But I think for most people here on the call, you're probably running an LLC or an S corporation, so you can just kind of ignore number 5 unless you are running that C corporation. Okay, so what is qualified business income? I think I just mentioned it's the net business income that you have across all the businesses in order to calculate the 20% deduction. It does include your rental property income. It will include rental property sales. So if you have a rental property and you sell it for the year, and let's just say you sell it for make a profit of $200,000, you will be able to apply the deduction to the rental property sales. It will apply to fix and flip income. So if you're in the business of being what we call a real estate dealer or doing fix and flips, it will apply to that. What it does not apply to is it's not going to apply to any wages that you take. So if you do real estate on the side and you have a W-2 job working for somebody else, it's not going to apply to that. If you have your own business as an S corporation, for example, and you take out wages from that company, you will not be able to apply the deduction to your wages being taken from your own business. If you are a partner in a partnership and you receive guaranteed payments, it's not going to apply to that. It isn't going to apply to any type of investment income, interest and dividends. And, if you have royalty income, for example, it won't apply to that. And then it's not going to apply to capital gain income. So there are some exceptions there, but I think what they were looking at when they were drafting this is really just looking at more on the active side of business income, even though we know that with rental properties that can be more of a passive activity, but luckily for us and for our purposes tonight, they did include rental property income in those classifications.
And so, Stephanie, some people, like you just mentioned, rental properties may be something they do on the side. So if somebody has a W-2 job, and let's say maybe that's over 315, but the business income, their rental property potentially is under that, would they still qualify for that 20%?
We're going to talk about that because, again, if their overall taxable income is over $315,000, they can still qualify to take the 20% deduction on the rental property income. They just have to jump through a few more hoops. Okay, so we'll talk about that. Now, and again, $315,000 is for a married couple. If the taxable income is under the $315,000, including the wages and the rental property income, then they'll automatically qualify to take up to the 20% deduction on the rental property income. Okay, so
Gotcha. Great, thank you.
So again, it gets a little more tricky as the taxable income of the taxpayers get higher. Okay, so as I just mentioned, we'll talk about this for a few minutes here. So the benefits for higher earners are going to be capped, and it's capped based upon what type of wages their company, or if you're getting a K-1 and you're an investor in a company, what type of wages the company is paying, and then they also look at the depreciable property of the company as well. So you can see that once the income goes above those limits that we talked about, now we've got to go in and look at a couple other things to see how we're going to calculate this deduction. So, and here's the confusing, so to speak, calculation here that we have at the bottom of the slide. So you're allowed a deduction based on the lower of or the lesser of your combined qualified business income, or an amount equal to 20% of the excess of your taxable income over any net capital gain for the year. And then and then you have to look at, if you look at Part B here of the secondary slide, you have to look at the wages and then the unadjusted basis of all the qualified property. So your heads are probably spinning right now. What exactly does this mean? So let me just give you an example here. So let's say that your taxable income is $400,000. And let's say that $200,000 of that amount is just from, let's say that your spouse has a W-2 coming in. And then let's say that the other $200,000 is generated from your fix and flip business. Well, we know that you're not automatically going to take a $40,000 deduction on your fix and flip part of your income. Even though it is qualified business income, it's not going to be automatic because we know that your taxable income is well over the $315,000. So we then have to go and look at we have to look at this calculation here. So we're going to start with the 20% of the taxpayer's share of the qualified business income. So again, if we're talking about $200,000 of fix and flip income, we're going to start there with $40,000. But then we have to go to Part B here, and we have to look at what's the greater of 50% of the wages the qualified business pays, or the sum of 25% of the wages, or 2.5% of the unadjusted basis. Well, let's say that that company paid out 0 wages to the owners and it has no employees. What's our tax deduction going to be? It's going to be 0. So this is what I was saying earlier. You can see that this is going to create, a lot of issues for taxpayers that potentially could take that 20% deduction on their business income, but if they're over the income limits that we talked about, they now are going to be restricted from taking that deduction because they haven't paid any wages, and if they don't have any depreciable property, they're going to be potentially restricted. So I've been doing a lot of advising with clients for the past couple weeks. In some cases, we've had to look at the wages that are being paid. We've actually had to implement those wages in many cases. You have to look at whether that's going to make sense, because keep in mind that if your company increases wages to make this work, or if it hasn't paid wages at all, you have now self-employment tax that you're going to have to pay on those wages. So this creates a situation where you're really going to have your tax professional dig into these numbers, figure out the best way that this is going to work, figure out kind of the sweet spot between how much do you need to pay in wages to make this work, based on any additional self-employment tax you're going to have to pay. I mean, in some cases, the self-employment tax on wages is going to perhaps eat up any of the 20% deduction that you may be able to take. So, again, I don't expect you guys to leave here and fully understand exactly what this means. Just note that if your income, if it's over those specified amounts, I would urge you to call your tax professional to discuss, and again, you'd have to have a business operating that would fall within the qualified business income allowances. I urge you to speak to your tax professional and go through this calculation with them and say, okay, does it make sense for me to add wages, or if you already are paying wages, are they too low? Because what if you, on that $200,000 business that we're talking about, what if you're only paying yourself $20,000 of wages? Well, now, you're not going to get that $40,000 deduction. You're not going to get that 20%. You're going to get 50% of the wages. Well, if you're paying yourself $20,000, now your deduction is $10,000. So you can see that it takes some maneuvering. You may want to increase wages that you're paying. You may want to decrease them. You've got a lot kind of going on here, and this really just takes a certain tax professional who really understands these rules and understands how to make this work based on your business and what you're doing. Okay, so with that mess that I just kind of shared, I'm going to move on kind of to the next slide. And we'll go on to even another tricky part of taking this deduction. It gets even trickier when you're in the specified services trade or business. So again, if your income as a married couple is under $315,000, and if you're single or filing separately, $157,500. And if you have a specified service trade or business, if you're a realtor, if you are an accountant, if you're a lawyer like myself, if you're a consultant, if you do IT consulting, if you fall within these trades or businesses, you automatically will qualify to take that 20% deduction, just like you would if you are in real estate. But again, once the income hits over those limits, we've got even, in my opinion, worse complications than we had with the non-service related businesses. So I put a list here of what they have explained, is going to what type of businesses here will fall under this rule. And so you can see law, accounting, health. So if you're a physician, if you're doing any kind of consulting, financial services, brokerage services, investment management, if you're a trader in securities, or, look at this last bullet point here. That's it's, kind of a vague classification here. Any trade or business where the principal asset is the reputation or skill of one or more of its employees. So if you fall within any of these businesses, then we've got even more complications here and things that we now need to look at in order to determine if that 20% deduction is going to apply. Again, if you're under those specified amounts of income, you don't need to worry. You just get the deduction and move on. But if your income does exceed those amounts, then you'll see that we've got some phase outs here coming. So if you're not sure about the business, that you're in, I've had a couple situations in the past couple of weeks where I've talked to clients because, they weren't sure if they were considered to be a service business. I had one client who they primarily sell advertising type space. And so we determined in that case that since they were doing mostly sales and it really wasn't based on their reputation or skill, it was based on the product they were selling, we determined that they would not fall under the service business classification. But again, if you're not sure, this is where you need to talk to your tax professional. And they haven't given us a ton of guidance here either. I do want to mention that. So, we're still kind of waiting on some more guidance, at least for that bottom bullet point there, because that to me is a more vague description of, some things that could apply for some people and then not apply for others, depending on what you're doing within your business. Okay, so if taxable income exceeds $315,000 for a married couple, and if it exceeds $157,500 for an individual, we start to see that 20% deduction gets phased out. So it's going to gradually get phased out, starting at those income limits. And once the income hits $415,000 for a married couple and $207,500, the 20% deduction is actually completely phased out. It's actually gone at that point. So if you are a lawyer and if your taxable income is $430,000, you can just forget taking that 20% deduction on your business income at that point. So we don't even look to wages. We don't look at the unadjusted basis of the depreciable property in your company. That doesn't apply here for service-related businesses. So you can see that what they've done here is they've really kind of, hit this industry pretty hard. I mean, I take a little bit of offense, to it as an attorney myself, but you can see that, they have definitely, for whatever reason, I don't know exactly what that is, but they've really just put, this restriction on being able to take this deduction on any type of service professional. So, if your income hits, if let's say you're married and your income hits somewhere between $315,000 and $415,000, well, the 20% deduction may be reduced. Maybe instead of getting the full 20% deduction, you're going to get a 10% deduction. So you still may get something, but you're certainly not going to receive the full amount if you are a service-related business. So again, hopefully that makes sense. I think it's a little bit easier to understand than the previous slides that we were looking at with the non-service related businesses with when the income is over the threshold amount. Okay, so Justin, any other questions about that before I move on?
Yeah, so there was a question, what about an individual trader in option securities?
So, That's going to depend. If you are what we call a day trader, or maybe somebody even who has made a mark-to-market election, then you're going to fall within the service-related business. If you are a trader of securities and you're doing it as an investment, then remember that we said that capital gains, you actually don't get that 20% deduction. So if you're just doing it on the side and you're not doing it as like a day trader or somebody who's trading full time, then you're not going to qualify for the deduction anyway. If you're a trader in securities, a day trader, then you potentially will qualify to take the deduction on your income. But again, you can't make more than that, these amounts right here that we're showing. And if you're not sure if you're a day trader or an investor, again, you need to talk to your tax professional, because there are very specific rules to determine whether or not somebody is actually going to meet the threshold of being a day trader. You have to spend a certain amount of hours per week, have a certain amount of trades, very strict rules on that. Any other questions?
Nope. I think we're all caught up for the moment.
All right. Well, that was crystal clear, so that's good to know. Or people are just like, I don't even know what to ask because I don't get what was going on there. So that's okay. I kind of felt the same way when I first was reading about all this. So, okay. So depreciation, there have been some changes there that are actually really favorable for real estate investors. So I wanted to talk for a minute about that. I just put a slide up here that just talks about the current useful life of depreciation, meaning this is how long it takes for you to recover the cost in your investment. So residential rental property, we depreciate the cost of the property over 27.5 years. Can go through here, commercial rental, 39 years, home office, 39 years, land improvements, 15 years, appliances, usually 5 years, equipment, 5 to 7, and then cars, we get a 5-year depreciable life on that. Now, we always want to look for ways, if we can, on how we can accelerate that depreciation. There in the past, there have been some ways to do that, but they've been really kind of restricted with real estate, especially with rental properties. And so that's why I think the new bonus depreciation allowances under tax reform have been really a good thing for our investor clients that have residential and commercial rental properties. So under tax reform, property with a useful life of 20 years or less, which you can see, land improvements, appliances, equipment, cars, it's not going to apply to the building itself because the building is going to be beyond that 20 years. But any property with a useful life of 20 years or less is now going to be eligible for 100% bonus depreciation, which means instead of having to depreciate things over 15 years, 5 years, you can now just write it off. Nice, right? This is really where it's going to be a big deal for you guys to really kind of scrub some of the things that you're buying for your property. And in some cases, you may need to do what we call a cost segregation analysis for your property. That's generally reserved for bigger properties that you're purchasing. So, if you're buying a multi-unit apartment building, for example, you may want to hire a professional to kind of go through and do a study where they're pulling out the appliances and the land improvements and things like that so that you can potentially take a much faster depreciable deduction on those versus, getting stuck with 5, 7, 15 years. So, again, this is the situation where you will have to, look at some of the things you're doing within your property and determine what has a useful life of 20 years or less, and then you can use this bonus depreciation provision. Now, this does not apply to things like repairs in your property. So if you have a rental property and the thermostat breaks or something, and the AC breaks or the heating unit breaks, and you just have to have a repair guy come in, those things aren't normally depreciated anyway. They're just taken as an expense, as a repair expense. And we're not talking about repairs. We're really just talking about the purchase of the building and its components, and if you're making improvements to the building over time. That's what we're talking about here with depreciation. So I just wanted to distinguish there. Before tax reform, we actually had this de minimis provision election, and that allowed us to take a tax deduction of up to $2,500 for personal properties. So that really was limited to things like appliances and, you know, if you bought furniture for your property, but really nothing else. So we kind of already had something before, but it had this $25,000 cap on it. So, you know, if you were buying appliances in your property, you could write off up to $2,500 per appliance. But, you know, having this 100% bonus depreciation is really cool because we don't have a $2,500 cap anymore. We can just go ahead and, you know, if you put in a fence, that's $10,000. A fence would be a land improvement. You can now just go ahead and write that off.
So question along those lines, what if you had a fence installed, say 2 years ago, and you're depreciating it over a couple of years? Can we then now accelerate that, or
No.
does that have to continue along whatever path it was on?
Yeah, you'd have to continue along. So this is really just going to be property placed in service in 2018 or beyond. And, you can use it for new or used property, but you can't use it for existing property.
Gotcha. Okay. And then there was another question. Yeah. There's another question. Are business deductions still allowed on Schedule C?
Are business deductions? Yeah.
Yeah.
Yeah, absolutely. I mean, if you have a Schedule C, which again, when you file a Schedule C, that means you either are a sole proprietor or you have a single member LLC and you're running a regular business. We're talking about rental properties right now. So for rental properties, we're filing a Schedule E or a Form 8825 if the rental is held in a business entity. But they haven't, we'll go over a couple of the changes on some business deductions. Really, it's just the entertainment one that has the biggest change, but you can still write off most things under your business. Okay, and then Section 179, a lot of you may be familiar with that. That's been in place for, as long as I've been practicing. That was it's an expensing allowance. So again, it gives you the alternative instead of taking a depreciation deduction to use the Section 179 allowance. But in the past, it actually wasn't really available for certain rental property components. Like you couldn't use Section 179 for appliances and land improvements. So again, having the bonus depreciation there now is great. But I did want to make mention that this under Section 179, they have now allowed for non-residential improvements for heating, ventilation, roofs, air conditioning, security, and alarm systems. You can actually now just write that off under Section 179 of the code. You could use bonus depreciation too. So, I guess it's kind of a, whatever way you want to take this. But again, in the past, Section 179 was not allowed to utilize it for residential rental components, and then it certainly wasn't allowed for non-residential as well. So there's a limit on using Section 179. The business actually has to have a profit or the deduction gets carried over. So I'd recommend, and again, leave this all to your tax professional, but I'd recommend that you try to get the bonus depreciation first, use that up, and then if for some reason there's a limit there, you can go and look at the Section 179 deduction and try to take some things there. There's still this de minimis election that's in place as well. I'm not sure we're going to need to look at some of these things now that we have bonus depreciation, but a situation could certainly arise for that. So, and when you're looking at your tax return or signing off on your tax return, I want you to at least have this in your head now so that you can be educated. A lot of people they get their tax return, they don't even really understand what it means. They don't go over it with their tax preparer. They don't even, they just kind of sign off on it and say, okay, but this is a situation where you want to make sure that your tax preparer didn't forget to give you this or that they knew about this. I mean, for example, if you have a rental property and you put in, let's just say you put in $15,000 of land improvements in 2018, well, you want to make sure that $15,000 now was deducted in full. You don't want to go in there and say, where was it? And then you find out that your tax preparer deducted it over 15 years, which is the old rule. So these are some things that will hopefully give you some more useful information so that when you're doing your taxes, you'll know some things to look out for to make sure that you're getting the best tax results. And
so a quick example of that might be replacing a driveway, correct?
Mm-hmm. Yep, a driveway, a fence. Some people have like sheds on their property, a swimming pool, perhaps. So things like that, jacuzzis. I mean, those would be land improvements. Obviously, landscaping. would be a land improvement. And then, appliances are going to fall within these rules. If you're furnishing the rental property, that's going to fall within there. So again, anything with a useful life of 20 years or less. And if you're not sure what falls within that time period, then again, you need to talk to your tax person. They can really guide you on what's going to apply there. So, and just to give you an example of some things that would not fall within the 20 years, we're talking about granite, putting in cabinets, putting in like electrical or plumbing. Those things, unfortunately, are really going to be depreciable with the building itself, so they're not going to fall within that 20-year or less period.
Gotcha. And so here's a slightly different question. Are there any changes to properties held in a self-directed IRA or partnered with a self-directed IRA or any other non-IRA entity?
So we don't really do depreciation when you're holding your property in an IRA. So we don't, the property just kind of sits in there, generates potential appreciation when it sells, and we're not really doing taxes per se for it. So there's really no tax effect to the owners of the IRA until, down the road when they start taking out their distribution. So depreciation really isn't going to apply within the IRA. Any other questions about that?
No, I think we're caught up for the moment.
Okay, so let's talk about the new rules and the old rules for meals and entertainment, because this one's going to kind of sting for some of you. So the old rule allowed you to take a tax deduction of 50% of your expense for entertainment expenses. The new rule says you no longer can take a deduction at all for entertainment expenses. So if you have a business, and let's say that you frequently take clients out to dinner as, trying to gain their business or trying to gain referrals from them, well, no longer can you take a tax deduction for that. So I have a couple clients who are in sales, and they certainly spend a lot of their time and money just wining and dining clients or prospective clients, and they spend a ton on meals and, sporting events and concert tickets and things like that. Well, they're obviously not too happy about tax reform, noting that they can no longer take a tax deduction for that. So, I've gotten a lot of questions about this, because I've had a lot of people say, okay, well, even the meal with the client or the prospective client is not going to fall within just a regular meal expense anymore. It's going to be called entertainment. And yes. So if anybody tells you differently, because I've had a couple clients say, well, I heard from so-and-so, or I read online that you can still take the meal deduction expense when you're out with a client. I've looked at that part of the change quite thoroughly. I've spoken to several other tax professionals and former law professors, and we are all in agreement that that deduction is going away. Okay, so I just want to be clear about that, because again, I've gotten some pushback on that specific deduction when you're out with clients. So no deduction anymore for any kind of entertainment expense. So again, if you're taking out clients, if you buy them sporting tickets and then go with them, or you take them to a meal before, just note that deduction is completely gone. I mean, I guess the good news, if there is a good part to this, is you don't have to keep track of it anymore. There were specific rules that we had to have before for substantiation. The IRS, when they audit a tax return, a lot of times they will look at this deduction and require substantiation. You have to prove who you were with, where you went, when you went, what you talked about. I guess the good news is you don't have to keep track of that anymore. So if there is a good thing to it. Tickets to qualified charitable events in the past, you also could take 100% deduction for that, and that's also going to be gone as well. So if you bought your client, for example, a ticket to a charitable event, there's no deduction left for that anymore. Okay. So
got a couple quick questions on.
Let me go. I want to actually just explain what you still can deduct, because I don't think I put anything up about that. So and then I'll take the question. So if you are in travel status, so let's say that you have to go to Las Vegas to attend a real estate convention, that's still going to be deductible under the old rules. So that's you're still going to be limited to 50% of a deduction, but you're still going to have that deduction. Okay, so travel and meals and entertainment are still going to fall under the old rules. There was no change for that. If you are, let's say that you're in town and you are going out with one of your partners or one of your employees and you go and eat, you are still going to be entitled to take that deduction up to 50%. That's not considered entertainment. If you have like staff meetings where you require your employees to be, at the office and you have a meeting and bring in food, you can still take a tax deduction for that up to 50%. If you're bringing in office snacks, that actually doesn't even fall under the 50% that you would just get a 100% deduction for if you bring in like coffee and things like that. So just note that there are still meals expenses that are going to be deductible up to the 50%. It's really just the entertainment, which includes client meals, that is going away. Okay, questions?
Yeah, I think you actually hit them all.
Okay, good. So I knew there would be some questions about that. I should have put up another slide here, but wanted to make sure everybody understands that. Okay, so a lot of you probably know about the mortgage interest and the caps there. I do want to mention that when we're talking about the cap on the mortgage interest, as well as the next slide, which I'll talk about on the property tax, this doesn't apply to your business dealings, okay, because I've gotten a lot of questions about this. Well, now I can only go out and write off interest up to $750,000 on all my rental properties. No, this is only for your primary residence and a second home, which is used for personal. So it doesn't apply for your rentals, doesn't apply to your fix and flip business. You can still take the deduction for the interest there. So before, if you went out and bought a new house, you could take out a loan of $1 million and you could write off the interest. Now they've dropped that limit down to $750,000. So we've got a reduction there. If you have a HELOC, or you are going to purchase or put a HELOC on your personal home, you actually can't deduct that at all anymore. So even prior HELOC, if you're grandfathered in with the $1 million rule, so if you had mortgage debt that you incurred before December 15th and you were up to that $1 million cap, you can still write off the mortgage interest as long as the loan was in existence before December 15th. But HELOCs, they've actually eliminated them altogether, so you don't even get grandfathered in with having a HELOC under the old law. So unfortunately, just kind of kiss that one goodbye as far as your HELOC goes. And from what I've read, even if you use the HELOC for business, you should be able to take that deduction. But there isn't 100% clarity on that. Remember, as I said, that some of the things they drafted, it was done very quickly. They still need to give us some guidance on certain things. They've definitely got some technical errors. The consensus is that if you're using the HELOC for business or investment, you can deduct it. But again, we're waiting for 100% clarification on that. So, I guess we'll keep everybody apprised of that as soon as we know. But for sure, on the primary home, the limits are now reduced. And then on if you're going to refinance your home, you still have to stay within those limits as well. And then again, just note that this does not apply to your business and investments that you have. Okay, and then state and local taxes and then property taxes, they're going to be capped now at $10,000 per year. And, this is a situation where a lot of my clients are well over these amounts. I mean, I've got clients that, some of them have state and local income taxes paid $40,000, $50,000 per year. Some of them are more than that. Luckily, we don't have crazy property taxes here in Colorado, but certainly the state and local income tax, if you're, in the higher earner situation, you could be paying a lot. And to have that capped at $10,000 is quite the hit for a lot of my clients. So, again, you want to talk to your tax person, see where you're at with that and see how, is this going to affect you negatively. based on the other deductions that you may now be able to take. Is it going to, are you going to just about even out? These would be some questions that you'd want to bring to your tax person, but the $10,000 per year is kind of a slap in the face. We do have several states now that are actually suing that this is unconstitutional. So I think, I saw that New York was one of them and a few others, and I'm sure we'll see more jump on board here. So we'll see how that turns out. Maybe they'll revise this and put it back to the old law or raise the cap. But the $10,000 is pretty ridiculous in my opinion. So and again, this is for your personal property. Okay, so it does not apply to rentals and your business property.
Okay. Yeah, because that was going to be one of the questions. Is it capped per property? But obviously it's just really on one or maybe two, a primary and maybe a second home, not on rental properties.
Right. Yeah, and keep in mind that these last two slides, so the mortgage interest caps and the state and local taxes and the property, this is all going to be if you itemize. So if you are, if you have a Schedule A that you file with your tax return, this is where you take those deductions. So if you didn't itemize in the past, this isn't really going to be applicable. And then remember, you're going to get that double that standard deduction. So some of this, if you don't have a huge amount of taxes that you've paid or property taxes, and if you're, you don't have a mortgage, this really doesn't matter. But I think for a lot of people on the call, you're itemizing, and some of this is going to greatly affect what you're doing here. So.
Gotcha. And so one more time, you can still deduct mortgage interest on rental properties.
Oh, absolutely. Yep. No cap there at all.
All right. Maybe two more questions here. Let's see. If you have a private third-party loan on your personal residence and you could move it to a rental property easily, would that matter based on the slide, assuming that the debt is less than $1 million?
Okay, so let me make sure I understand. So there's
I think you're going to walk the mortgage to a different property.
So you're gonna refinance it to the business property?
Great question. I don't know.
I don't know either. I think I'm not clear what that question is, so I would just say shoot me an email or give the office a call and give me some more information because I'm not exactly sure. I mean, I can tell you that again, if we're talking about a loan on the business property, there's no cap at all, so you'll be able to fully write off that interest. And if you have current loans on, like the HELOC, for example, if it's tied to your personal house, remember if you use the proceeds for business or investment, you should be able to write that off. So again, I'm not exactly clear what that question is.
Gotcha. So I think they're going to reach out directly to you for some clarification. Well, we're getting close to our time here, so I'll see if there's any more questions, but let's have you keep going through some more slides, and we'll see if we don't answer some of these questions as we keep wrapping up.
Okay. Yeah, and just note, too, that because the home office is considered business use of the home, you can, you won't be subject to some of these caps. You can still take the home office deduction, so that's even more important, in my opinion, to calculate a home office, so you can, you can maybe write off some more of the property taxes that you may have been capped out with. So don't forget the home office, not a red flag. Miscellaneous itemized deductions, those are deductions that, again, fall on the itemized deduction schedule, the Schedule A that you would file with your personal tax return. Those are gone. So no more writing off your tax preparation fees on the personal side. Remember, you can still deduct your business tax prep fees with the business return. So you do it on your business tax return, or you do it with the Schedule C. You can't write off investment expenses. If you're a W-2 employee, I explained earlier, the unreimbursed employee expenses are gone. You can't write those off anymore. Loss, if you have a loss in your IRA, that's a lot of you would never have seen that, but I had some clients lose so much money in their IRA accounts, they had to shut the IRA account down and then potentially take a loss. That's gone. Trustee fees, job search, legal fees. So anything on that Schedule A, which was a miscellaneous itemized deduction, those are going by the wayside. I've gotten some questions on 1031 exchanges. Good news, they did not change the law for real estate transactions. So I think, most of you on the phone here on the call you're dealing with real estate, so you can still use 1031 exchanges on your rental properties. You just can't use them any longer for other types of trades and exchanges, things like equipment, machinery, autos, aircraft, and boats. So again, I don't think this is going to be a huge deal for most people, just based on the fact that they did keep real estate in there. The earlier provision of the bill had taken it out, and so that's why I wanted to make sure that everybody knew that they put it back in. So that hasn't really changed for real estate. Casualty and theft losses are now gone. So if somebody robs you and you have, the insurance doesn't cover everything that you lost, you can no longer take a tax deduction for that. One exception to that would be losses incurred in a federally declared disaster area. So that would be things like where the fires happened, where the hurricanes happened, things like that. But otherwise, if your house just flooded, kind of a fluke thing, or again, you had, somebody burglarize your house, those deductions are going to be gone now. You do want to make sure you have adequate insurance, just noting that you'll no longer have a tax deduction there. Raise limits as needed. Obtain flood insurance. Most insurance policies do not cover flooding, so you do need to have a separate policy for that. Obviously it was a good idea to have all this insurance before and have adequate limits, whether or not you get the tax deduction, but I think it's even a little bit more important now. Okay, and the miscellaneous changes, moving expenses are now gone, except if you're in the armed forces. So if you have to move for work you've incurred money to move across country for a job or something like that, you can no longer take that deduction. Alimony, that's a big one. That deduction is now suspended, and then the recipient no longer has to claim it as taxable income. Professional gamblers may no longer deduct anything more than net winnings, so no more gambling loss deductions. And again, this only applies to professional gamblers, so I haven't really seen a whole lot of those over my career. 529 plans, actually, this is good. They have expanded the use of accounts for things like private schools. So you can now use the money there's a much broader way to use the money than what you had before. The medical expense deduction, and again, this is if you itemize your deductions. The cap used to be, it needed to exceed 10% of your adjusted gross income. It's now at 7.5%, which was actually the law before the 10%. It was 7.5, went up to 10%. Now it's back down to 7.5. We have, we're going to see less AMT, less alternative minimum tax hitting a lot of you, especially if you're a higher income earner, because they have increased the exemptions, which in effect lowers the AMT tax that will apply. And then we have a 21% flat tax rate if you have a C corporation. So those are some of the miscellaneous changes that we have as well. So I've mentioned throughout, you're going to have questions, especially on that Section 199A deduction. Make sure you work with your tax professional. Make sure they understand it. You'll be able to tell when you call them if they really have a good handle on that and what needs to be done to help you plan to make sure you can maximize that. So I think we're here at the end of the presentation. I don't know, Justin, if anyone else has any other questions for me.
Yeah, a couple. So we just talked about alimony. Here's a question. Is the alimony deduction for people getting divorced in 2018 and later, or does it apply to previous years?
It's grandfathered in. So if you are already paying alimony, you get to keep that deduction. But if you are getting divorced in 2018, you no longer will be able to do that.
Okay. For legal fees, can we still deduct for businesses like rental properties, etc.?
Yes. Yep. Anything that I talked about tonight, as far as the miscellaneous deductions and things like that, again, that doesn't apply for business deductions. So the businesses are kept separate from all of that.
All right. Here's one. What happens to carryover losses for C Corps or LLCs from pre-2018 tax years?
Well, those will continue. So for C corporations, remember the C corporation losses, they're kind of separate, so they don't apply to you personally. They don't flow over to your personal tax return. That's not a pass-through company. So those losses will continue to roll over as they always have. they didn't do really much with that as far as tax reform goes. And then on the personal side, because we're talking about a pass-through company, if you had let's say you had an LLC and that LLC generated a loss, the loss would have already passed through to your personal taxes, and you would have used it to offset all of your income there. Now, if on your personal taxes overall you had a loss, you can continue rolling that loss forward. There haven't been any changes to that.
Gotcha. Very good. And do you have a slide with your contact information?
I
Do you have
do,
one more
right here.
slide? Perfect.
I think that's it. That's the last slide. So there's my phone number. If you, email is actually probably the best to shoot me an email. I'm usually pretty responsive. If it's pretty quick, I'll respond. If I feel like I need to talk to you on the phone, we'll probably have to schedule an appointment. You can always call the office to make an appointment. If some of you actually want to get feedback on that Section 199A deduction, I would recommend calling my office and making an appointment, because it's not something I can do over email. I'm going to need to see your tax returns. I might need to see financial statements. We're going to have a lot to talk about. So definitely call the office in that case.
Gotcha. So we've got maybe two more questions here. Back to someone asking about that third-party mortgage and stuff. So I think they're trying to give a little clarity here. Let's say you have a HELOC on a primary residence, and that HELOC is big enough to buy the entire rental property. Can you then deduct the interest on that HELOC?
Yeah, that's what I was saying earlier. If you're using the proceeds to, purchase a rental or put it down payment or use it for business, everything that I've read says that it's going to be allowed to be used for business or investment purposes.
Gotcha. And then back to the alimony type questions. Is it an option to not take the alimony deduction for previous divorces? It wouldn't affect me as a write-off, but will benefit my ex if she doesn't have to count it as income.
That's actually a really good question, and I'm not 100% sure about that. So you want to forego the alimony deduction, and then the wife or the ex-wife forgoes picking it up as income?
That seems to be what they're asking.
Yeah, I don't know. I'd have to actually look into that. So shoot me an email on that. I'll check for you and let you know. I don't know why most of my clients would never want to do that, because, they're usually mad at them, or, they want to get that tax deduction. But that's a good question, so I can check on that for you.
Well, very good. Well, Stephanie, I think that's all the questions we've got. So that was awesome. A lot of highlights. You probably got a lot of people's heads spinning. Certainly mine. I wrote down questions that I'll be following up with you on. I think some people are starting to log off. Everyone, thank you for coming. Again, if I did my job right, then we will have recorded this and it'll be up on YouTube here shortly. So feel free and wait and check out that to refer back for more information. Stephanie's information is on the screen right now. Be sure to reach out to her directly. She is great. That's why we work with her. She does all my stuff personally as well. Any last thoughts, Stephanie?
No, I mean, I'm sorry to make everybody's head spin on that, but that's what, it's just typical, right, of the tax code in general. So they've certainly made it more complicated in some respects, but also simplified it as well. So hopefully you guys have a good, basic understanding of some of the less complex changes, and certainly if there's things that you need to discuss more, then be happy to discuss that with you or give your tax person a call.
Awesome. One last question, Stephanie. Can you deduct reverse mortgage interest?
Reverse mortgage interest. If you're paying interest on a mortgage, yes, you're going to still fall within those limits, though. If it's for business or rental property, you'll deduct it, as you normally would, no caps. And then if it's tied to the personal property, you're going to have those limitations.
Perfect. All right. Stephanie, thank you so much. Have a great night, and thank you everyone for joining us, and check us out next month for the next webinar.
Thanks, everybody. Have a good night.
Thanks.